This week sees the Bank of England likely cut interest rates. That comes despite the rise we're seeing in inflation, but there's concerns around the UK economy. There's a black hole in the public finances, and we're expecting to see tax hikes down the line. So where do we stand in terms of the interest rate decision this time around? What's going to be the market reaction? What's the outlook going forward? And how is that going to impact the pound and the FTSE 100? All of that and more in today's video as we try to cover the upcoming Bank of England interest rate decision on Thursday. So, like I said, markets are expecting movement this time around, and you can see it in terms of the top line of this graph. Essentially, 7th of August, which is Thursday, brings a 93% chance of a rate cut. 25 basis points taking us down from 4.25 to 4%. Now, this essentially comes against the backdrop of a Bank of England that is stuck between a rock and a hard place, essentially. And they're not the only ones. It's the same kind of picture at the Treasury. Ultimately, they want to stimulate the economy, but they already have rising cost of borrowing or elevated cost of borrowing, rising debt. And so they need to try and fill a hole in terms of that debt. And that doesn't even really account for them adding any stimulus to the economy. So on the fiscal side of things, their hands are tied. They don't really have much room for maneuver unless they're going to somehow raise the 20 to 30 billion pounds per year that's needed to close the black hole essentially in the public finances, and that's not going to happen. So when it comes to the autumn statement, that's going to be a case of just trying to fill that hole essentially. And the flip side of it is the Bank of England. So the Bank of England can step in and try and help things in terms of stimulating the economy, but that would have to happen against the backdrop of rising inflation. And that's something we'll touch on here. So out of the two, the most likely of the two was always going to be the Bank of England, and that's who looks likely to step in on this occasion. So expectation is we're going to see a rate cut this time around. But by and large, when you've got markets expecting it to such a high degree, 93% chance, the market reaction probably is going to be relatively muted. It's not going to be a surprise when this event happens, right? So the only surprise really would come in the form of a decision to pause once again, or else in the form of the outlook going forward, the outlook for the economy, the outlook for future interest rates. And the outlook for the economy essentially is just a nod to how they see interest rates moving as well. So you can look beyond this meeting and say, okay, where do we go from here? You can see interest rates looking to move beyond this meeting. Perhaps in November, you can see 54% attached to the 25 basis point outcome, and an outlier 11% attached to the idea that we'll be down to 3.5% by that November meeting. Of course, those numbers kind of increase as you go towards the back end of this year. So markets are actually pricing 2 rate cuts by the end of the year. That's nothing to be sniffed at, quite frankly, considering we're in August. We do have rising inflation, but it's not a given. And certainly, there's a lot of uncertainty over exactly what the Bank of England is going to do, the pace of easing. They've been very hesitant throughout all of this. And latest price movements in terms of price levels really doesn't provide them with the basis to think that they can start ramping up easing to a rapid degree. It's just not that sort of way that they're positioned. So they're going to have to be cautious. How cautious they're going to be remains to be seen. How that trajectory in terms of interest rates moves relative to other countries, that's going to be important for the FX markets. So let's look at the sort of picture that currently they're facing. First and foremost, on the economy side of things, you have negative GDP growth for the last 2 months. Now, this is important because many of the assumptions under which the budget was created were built on assumptions around growth. And clearly, the UK, from a growth perspective, not necessarily in a great position. Whether that is going to turn upwards remains to be seen. But certainly if we see strong growth numbers, then suddenly things start to improve. Suddenly we have that sort of black hole sort of disappears, and they have increased tax receipts. They have lower welfare expenditure and the like. So they pay less out, they receive more. Suddenly the public sort of financial position is much better, or the treasuries. The flip side of that is if we don't necessarily see an improvement, we continue to see weakness coming into the fore for the UK economy, then, of course, we just continuously try to essentially patch up a hole that keeps being opened once and again. So the GDP numbers are going to be really key, but that's certainly something that is sort of tying the hands of the Treasury. But on the flip side, it's probably providing the basis for the Bank of England to think they have to do something. Unemployment rate rising. It's not necessarily the highest of the lot here. You can see it is gradually rising, has been rising. That's part of a sort of jobs market dynamic in the UK that isn't necessarily looking great. You can see it once again here. The blue line is the unemployment rate. So you can see that upward trajectory of late. I think we're at 4.7 now. And then we have the claimant count. Now, to be fair, I probably should have just got rid of that that massive spike that we saw around the pandemic because it just completely skews the way that we see the smaller numbers, the more sort of normal numbers. But what you can see here is that we're seeing a rise over the past couple of months in terms of the claimant count. So higher claimants, higher unemployment, not necessarily a great position for the UK, especially given the negative GDP figures we're seeing. Then you set that against inflation, which is on the rise. Core CPI up to 3.7, headline CPI 3.6. That's a far cry from the 2% we need to see, and certainly far away from many of the other countries within the G7. The UK has the highest G7 rate of inflation. Certainly many of them are in the twos. The UK mid threes, and a lot of that comes down to some of the policies of the Labour government when they came into power. Of course, they were trying to raise funds, but they essentially promised they wouldn't tax working people. Then that has tied their hands behind their back, and they end up just trying to move in different areas, whether it's trying to raise national insurance contributions on businesses and the like. And so you're going to see that wrangling once again when it comes to this next autumn statement. Essentially, they're going to have to try and find ways to raise money without raising the likes of income tax and the like. So what we're looking at here is one massive inflation figure for April. And from there on in, you can look at the figures either side of it. We're looking at this middle section here, the month-on-month numbers, elevated for April, but they were elevated for February, March, not necessarily May. That's kind of on track, and then June. So the past 6 months really has been problematic from an inflationary standpoint for the UK. And you can see here in terms of the 9-month annualized, if you fast forward 3 months, where are we from here? We're actually higher. So the trajectory that we've seen over the course of the past 6 months has certainly been a problem, to say the least. Now, in terms of the UK from a borrowing cost perspective, what we've seen is elevated borrowing costs, no small part because of the fact that we haven't necessarily seen rate cuts coming into play from the Bank of England. So as long as they sort of stand still, you're in a position where elevated interest rates lead to a higher cost of borrowing. That, of course, is problematic when you have rising debt. So there will be a need to drive down the cost of borrowing, and there's a number of ways to do it. Part of it will be the central bank cutting interest rates. And you can see here in terms of the green line, which is the UK spread of yields for the 10-year over the German, you can see there's a really significant differential in terms of the cost of borrowing. The UK needs to bring that down in a dramatic manner because it essentially puts us in a more difficult position when it comes to rolling over debt or taking on any new debt. So the UK needs to cut rates, in part for the economy, in part for the borrowing picture and the elevated borrowing cost. But of course, inflation is elevated, and so the UK isn't necessarily in a position to be able to ease to a significant degree. And so when we look at this meeting, it's really about how much is the Bank of England willing to do in the face of their primary target, which is keeping inflation down to 2%, being massively out of reach, right? You could explain away that 1% bump in April inflation and just say, well, that's policy, right? And in the same way as we're seeing with the Federal Reserve, there's a lot of talk about, oh, can't you just overlook the tariff-fueled inflation because it's a one-off inflation bump? And many in the Federal Reserve have said they would be willing to do that. So it could be the case that the Bank of England takes a similar stance, and then we're back in action, right? So I just think it's unlikely we're going to see them coming out with super dovish statement and a pledge to start cutting at each meeting. So from that point, there's a good chance that we actually start going into the opposite direction. The opposite direction being that, okay, they do take action this time around. in terms of cutting interest rates, but maybe it's not necessarily something that is going to be too regular. And so market optimism around that sort of fades somewhat. Let's look at the chart. We're going to look first and foremost at the chart for euro sterling. Now, I've overlaid euro sterling against the 10-year yield differential, or the ratio between the European 10-year, UK 10-year. And you can see here, as we see sort of rising yields coming into play, so you see euro sterling on the rise recently as well. So ultimately, what you're looking at here is a trend where you're seeing the relationship between yields and the currencies really holding up. Now, in terms of the wider context, you can see that we've been seeing a rebound. This is something that I've been talking about for a while now. And in part, let's just get rid of that. In part, this is around the idea of expected movements from the central banks, not actual movements from the central banks. Because bear in mind, the likes of the ECB have been cutting interest rates. The Bank of England have been doing very little. But as the ECB gets closer to the point where they essentially stop, so the Bank of England is likely to start ramping up easing. And so sometimes you have to get ahead of the game. That's why we were talking about this down here. And we've been seeing a very nice trend ever since. Now, that started to sort of unravel a little bit. And so there's a question mark on, do we start to roll over if we see the Bank of England taking a more sort of hawkish stance? You know, are we actually able to see the Bank of England take action? Are we not? What's the outlook for the Eurozone, given the fact that they, of course, have a trade deal, but what's that going to be look like for the economy going forward? Will the ECB need to intervene once again? If we look at the 4-hour chart, there's certainly some risk inherent within this chart, because you can see from a wider perspective, you see these big swings back, right? So we've seen this latest ascendancy. So you can see down here, let's just grab, there we go. So we've seen this latest push higher, where it's essentially sort of channeling upwards, right? So let's just try and get that top part as well. Try and grab some of these peaks. So there we go. So we've got this ascending channel, and price has sort of dropped back down through that, taken out your first swing low, which is this level down here. And so let's just get that onto regular. So we've taken out that first swing low, then we've rallied. So the question mark here is this a retracement? And we're going to follow up that channel breakdown with a retracement before we roll over once again. Well, from a fib perspective, we've come into this 76.4 fib and started to roll over a little bit. That for me is a bit of a warning sign. It points towards a possibility of euro sterling to roll over. So some strength coming back into play for the pound. It doesn't necessarily mean that we're going to unwind this entire move and that we're bearish for a really long period of time. I just think there's a strong chance that we see a stance that, yes, they cut rates, but markets are pricing that in already. And then, you know, how hawkish or dovish are they? I don't necessarily think they're going to be super dovish as a result of that inflation picture. So that points towards a possibility of this holding us off and potentially sort of retracing some more from here. The wider trend does still hold up. I do think at some point the ECB is not going to be easing anymore, and we're going to see the Bank of England easing at a more rapid clip. Whether that's right away, don't necessarily think so. I think we could start entering into another retracement phase here, and that breakdown through swing low support, and then the rally into the 76.4 fib and a breakthrough this channel support. Yeah, it's a bit of a warning sign for me. Now, that trend, of course, still does hold. So the wider one does. So we do have the possibility that we break through the 87621. And if that happens, then, yeah, we're back on track with that trend. But until that happens, I'm hesitant. I think there's a possibility that we see some bearish price action coming into play. In terms of the FTSE 100, regularly hitting record highs of late. Last week, you can say, is probably the exception, sort of coming off a little bit, but ultimately we're sort of grinding higher now. You know, we did see that sort of rampant move high, and then you move into a more considered phase, then you move into sideways consolidation, then bump up once again. Well, we could be moving into a sort of bit more of a choppy consolidation phase. Of course, we did see the data coming out of the US on Friday, a little bit of a shock to the system in terms of not just the payrolls, but also the revisions to the prior numbers, the rising U6 unemployment rate, the falling participation rate. Doesn't necessarily paint a particularly great picture. So with the fact that we did break through this double top neckline, we're now rallying once again. You know, if we break up through resistance and then push into new highs, then okay, fair enough. But we're starting to show some signs that we could move into a sort of choppy phase, a retracement phase for the FTSE 100, especially we broke through that neckline, we broke through trendline support. Yes, we're rallying at the moment, but again, this could be a retracement before we see it sort of falter and stutter once again. So look out, a breakthrough 9,200. Yes, fine, everything's all nice and dandy, but there's risks here. If we see a relatively hawkish stance coming out from the Bank of England, yes, they're going to cut rates. That by and large is being priced in by markets. But aside from that, you're looking at the possibility that they come out with a cautious tone, and we have the risk of the US economic picture souring somewhat. We've got the risks associated with tariffs around the world. You know, it's a difficult time of the year, August. You know, generally it can be a bit of a tough one for equity markets. Some would say we're relatively overstretched here when it comes to stock markets. So certainly one to be looking out for. But this breakdown through your trendline support, horizontal support, points towards a risk that this current rally that we're seeing at the moment could be a retracement at the moment, tagging that 61.8 and the ascending trend line. Do we see it falter from here or come into a deeper fib and then start to roll over? That, to me, is definitely a risk worth considering as we go into this Bank of England interest rate decision. I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.